Hello, my name is Alexa and I'm a 25-year-old living in Kansas City. I didn't grow up knowing about money. I didn't grow up with role models in money, and so I became determined to educate myself, and now I'm really focused on helping other people get from the place of not knowing anything to feeling super comfortable and empowered to handle and control their own finances. So in this video, I'm going to talk about what credit score is, why it matters, and how you can actually improve yours. Your credit score matters because it's kind of like a snapshot for lenders on what kind of borrower you are. If you have a sister and a brother, and let's say that your sister has asked you for money 5 times in the last month because she forgot her wallet at home, and she's only given you $10 out of the $100 she owes you from each of those 5 times. And your brother asks you for money. He's asked you for money twice in the last 2 months because he forgot his wallet at home, same thing, and he's paid you back as soon as you guys walked into the door. Who are you more willing to give money to again? Your brother or your sister? It would probably be your brother, right? And if you were keeping track of like, how fast do they pay me back? How much are they paying me back? Do I have to keep reminding them? Your brother would score a lot higher even though he has less opportunities to show his payment history. Your sister has 5 chances where she really has kind of messed up, and your brother has a quick return rate on his 2 times that he's asked you for money. So your credit score for lenders is actually used whenever you're applying for an apartment, you want to get a mortgage, a personal loan, an auto loan. So again, at the very surface level, it is a snapshot of how great of a borrower you are and how financially responsible you are. I asked ChatGPT to help me with numbers for examples of auto loans based on 2 different credit scores. And so for this example, we'll be using a 500 credit score and a 750 credit score. Anything above a 700 will give you better interest rates, but if you have above an 800, that's an excellent credit score and that will give you the best interest rates. So let's say that you're trying to finance a used car that's $20,000 for 5 years at the 2 different credit scores. If you had a 500 credit score, you'd be presented with about 22% interest rate, and your payments would be $543 a month at almost $13,000 in interest over the 5 years. If you have a 750 credit score, your interest rate would be closer to 10%, so almost half. Your payments would be about $424 a month, and you'd accrue around $5,500 in interest over 5 years. Just looking at the 2 different examples, this is a 250 credit score increase. You would save over $7,000. And I think that kind of shows the impact of this. Like, a higher credit score means that you can be trusted according to the standards that the credit companies have set. If you don't know where your credit score is, there are 3 major credit bureaus. I don't know about other countries, but in the US, there are 3 major credit bureaus: Experian, TransUnion, and Equifax. So you can make an account with each of the 3 credit bureaus and run a free credit report on each platform once a year. You can figure out where your credit score is. So if you want to hack the system a little bit, maybe in January you run it at one, and then in June you run it at another, and then in October you run it at the last one. So the things that make up the credit score are not talked about a lot. 35% of your credit score is based on payment history. So basically, do you make your payments on time, and do you pay at least the minimum payment? If you do that, then you will score excellent in this category, which makes up most of your score. Credit utilization makes up 30% of your credit score, and what this means is how much of the credit that you are given across all of your accounts, how much of that credit are you actually using every single month. This doesn't work in your favor if you don't have a lot of credit in your name and you're charging very reasonable things. So somebody in college might be given a $100 credit limit, which is barely enough for groceries for maybe 2 weeks if you're cutting it close. And then you would have a 100% credit utilization rate, which is really bad to lenders because it is kind of saying that you're spending out of your means, but sometimes your credit is really low, and they won't improve that if you have a low credit score. So it takes a while to be able to increase your credit limit on your credit cards. There are different rankings, and I'll put them on screen. What is scored as poor and excellent for credit utilization rate. One way you can lower your credit utilization rate is by increasing your credit limit so that the amount that you're using is staying the same, but you're increasing this part of the equation. So then this goes down. That's how like the proportions of the equations work. Or you can pay your statement balance off in full. You just need to do this by your payment balance date. Whatever shows up on your payment balance is what gets recorded. So that way it shows that your credit utilization is at 0%. Like let's say you have $1,000 credit limit and you spend $900 that month on your credit card. If you pay it off before the due date, then on the due date, it'll show that you used $0 out of your $1,000 credit limit. That is how you can kind of get around that. And also using your credit cards for their benefits and not as your lifeline is also how you get around that. Length of credit history makes up 15%. When I was 18, I got my first student loan. I'm now 25, so I have a credit history of 7 years on my longest standing account. And one thing that people will tell you is to not close your accounts. I also have a credit card that has been open since I was a sophomore in college. Whenever I finish paying off my loan, which won't be for another 8 years, I'm just paying the minimum payment since it's at a low percentage. If you want to know more about my debt story and why I'm not paying that off, click on this video here. I'll put here also what is poor and what is excellent when it comes to length of credit history. A lot of the time, the websites that you're getting your reports from will tell you how you can become excellent in these categories. The last two parts of your credit score make up 10% each, and that is new credit and hard inquiries, as well as your credit mix. New credit is what it sounds like. Whenever you open up a new line of credit, you start to owe people money in one avenue. That is a new credit. And also hard inquiries are included in this. If you apply for an apartment, even though you're not opening a line of credit, they still ran your credit, and that does hurt your score a little bit. I think why this happens is because it shows lenders that if you have too many new credit lines open within a certain amount of years, I believe it's 2 years, it shows that you are in a rush to get money and that you probably are spending outside of your means and you're spending more than you actually have. Hard inquiry means that you're seriously considering opening up a line of credit. And if you open up too many lines of credit for the reasons I just explained, you don't look good to lenders. Credit mix, I don't really understand this one. The way that I've rationalized it is like if you have credit from a car, from student loans, from credit cards, and maybe a personal loan, and you're responsible for all of these, you show that you are good at juggling different kinds of responsibilities and amounts of credit and that you can pay all of those back. Not really sure why credit mix is a part of that, because I don't really want to be acquiring a bunch of debt everywhere, but that's just how it works. That's how it's calculated. Having a high credit mix helps your score. Let's just quickly review everything one more time. Your payment history is the most important, and you can improve this category by paying the minimum payment on time. Your credit utilization percentage is better when it is lower because it's showing that you're not spending outside of your means. Length of credit history, that improves over time. I don't score excellent in this because I have not been old enough to even hold credit. This one will take time on its own and you can't really fix this one, but don't close any accounts, just keep them at 0. New credit lines and hard inquiries. You can decrease this by giving yourself at least 6 months between inquiries, because then you're only doing 2 a year and you can do a max of 4 inquiries to stay in the excellent or good category. And then your credit mix, I wouldn't go out of your way to open up new lines of credit. Honestly, this one, I don't really improve it. I don't pay attention to this category because I'm not going to go out of my way to get debt. But having a higher credit mix does improve your score. But I would say that's the least impactful. Like, I would just let that category be what it is based on your circumstances. If anybody's interested in hearing me talk about the credit cards that I have and a little bit more about how I handle my loans, please let me know in the comments. Let me know anything else you want to know about finance-wise, productivity-wise. Let me know if you had any extra thoughts about this video. If you have any questions, give this video a like if you found it helpful. Please subscribe if you want to hear my lovely voice again. Have a lovely day.